Let me ask you something. What if I told you that the Rockefellers, the Waltons, the Rothschilds, some of the wealthiest dynasties in human history, have never actually needed to sell a single share of their wealth to live like kings? What if I told you there's a completely legal strategy that allows the ultra-wealthy to access billions of dollars in cash, pay zero income tax on it, and then, when they die, pass their entire empire to their children, completely tax-free? And the government can't do a single thing about it? This isn't a conspiracy theory. This isn't a loophole that's about to be closed. This is a strategy baked right into the tax code. And it's been working for over 100 years. It's called buy, borrow, die. And by the end of this video, you're going to understand exactly how it works, why the middle class has never been taught this, and, most importantly, how you can begin applying versions of this strategy right now, regardless of your income level. Stay with me. This is the most important financial video you'll watch this year. Welcome back to the channel. If you're new here, this is where we break down the financial systems, wealth strategies, and economic frameworks that the top 0.1% use to build and protect generational wealth. We don't do get-rich-quick schemes here. We do get-rich-right education. Hit that subscribe button and turn on notifications, because what we're going to cover today is the kind of content that takes years of financial education to piece together, and we're going to do it in one video. Let's get into it. The wealth paradox. Why selling is for the poor. Here's a question that almost nobody asks. Why do wealthy people never seem to run out of money, even when they don't appear to be working? The common assumption is that rich people sell their assets when they need money. They sell some stock, liquidate some real estate, cash out some investments. Right? Wrong. That's what the middle class does. And that distinction, that one behavioral difference, is one of the biggest reasons why the wealth gap keeps growing. Here's the fundamental problem with selling assets. Number one, you trigger a tax event. In most countries, when you sell an asset that has appreciated in value, you owe capital gains tax on the profit. In the United States, long-term capital gains tax can be anywhere from 15% to 23.8%, depending on your income bracket. In the UK, it's up to 24%. In France, it can hit 34%. So if you bought Amazon stock at $10 and it's now worth $200 and you sell it, you just handed the government a massive cut of that gain. Every single time. Number two, you lose future compounding. This is the one that really hurts. When you sell an asset to access cash, you're not just paying taxes. You're also permanently removing that asset from your wealth-building engine. That stock you sold? It might have doubled again in 5 years. That property you liquidated? It might have appreciated another 40%. Albert Einstein reportedly called compound interest the eighth wonder of the world. When you sell, you kill the compounding. The ultra-wealthy understand this on a visceral level. Number three, it signals weakness. This one is more cultural and psychological, but it's real. In old money circles, having to sell is considered a sign of poor planning, even desperation. Old money families are taught from birth that assets are not to be sold. They are to be stewarded, grown, and passed on. So if they're not selling, how do they access cash? That's where the borrow part of buy, borrow, die comes in. But before we get there, let's make sure we fully understand the buy phase, because most people misunderstand what the wealthy are actually buying. The buy phase, what old money actually acquires, When the average person thinks about buying assets, they think about buying things that might go up in value. Maybe some index funds, maybe a rental property, maybe some crypto. Old money families think differently. They think in terms of productive assets, assets that generate income and appreciate and serve as collateral and can be transferred to the next generation with tax advantages. The asset has to do multiple jobs simultaneously. Let's break down the categories. Category 1, publicly traded equities, stocks. The Walton family, heirs to the Walmart empire, own approximately $200 billion worth of Walmart stock. They don't sell it. They don't need to sell it. But they can borrow against it anytime they want. Old money buys stocks not to flip them, but to hold them forever. The goal is to find companies with durable competitive advantages, what Warren Buffett calls economic moats, and simply hold the stock as it compounds over decades. The Rockefellers originally made their fortune in Standard Oil. When Standard Oil was broken up in 1911, John D. Rockefeller ended up with shares in 34 successor companies. He held those shares. His descendants held those shares. And the wealth grew exponentially. The key principle here: concentration builds wealth, diversification preserves it. Old money families often concentrate first, then diversify only enough to protect the core. Category 2, real estate. Real estate is the oldest wealth vehicle in human history, and for good reason. Property does something almost no other asset class can do. It provides current income, rent, capital appreciation over time, depreciation tax benefits, the ability to use leverage to acquire it, and it's an excellent collateral for loans. Old money families don't buy condos. They buy land. They buy commercial real estate. They buy farmland. They buy entire city blocks. The Grosvenor family in the UK, the Duke of Westminster's family, owns a huge portion of Mayfair and Belgravia in London. This land was acquired centuries ago and has never been sold. Instead, it's been leased to businesses and residents, generating rivers of income while the underlying asset appreciates. In the United States, the Irvine Company owns essentially all of Irvine, California, 93 square miles of land. They don't sell it. They develop it, lease it, and borrow against it. Here's a critical real estate tax principle most people don't know. In the U.S., you can depreciate commercial real estate over 39 years and residential rental property over 27.5 years. This means you can show a paper loss on paper for tax purposes, even while the property is generating real cash flow. Old money exploits this constantly. Category 3, private equity and business ownership. This is where generational wealth really accelerates. Owning private businesses, either family-operated or as investors, provides income and appreciation without the scrutiny or liquidity pressures of public markets. The Koch brothers built Koch Industries into one of the largest private companies in the world, worth over $100 billion. Why keep it private? Because they never have to report earnings to Wall Street. They never have to satisfy quarterly expectations. They can make 50-year decisions without a shareholder revolt. Private equity also allows for pass-through tax structures, like S corporations and LLCs, where the business income flows directly to owners and is taxed at individual rates, with many expenses deductible. Category 4, alternative assets, art, wine, collectibles, timberland. This is where it gets interesting for those outside finance. Ultra-high net worth individuals hold significant portions of their wealth in non-correlated assets, things that don't move with the stock market. fine art, rare wine, classic cars, farmland, timberland, precious metals. Why? Because these assets are often unregulated in their valuation, difficult for tax authorities to assess accurately, and can be gifted or transferred in ways that minimize estate tax exposure. A Basquiat painting worth $50 million sitting in a temperature-controlled vault isn't generating income, but it's also not being taxed annually. And when you donate it to a museum, you can take a charitable deduction at full fair market value, potentially eliminating taxes on other income. The common thread notice. What all of these asset classes have in common: they produce or preserve wealth without requiring you to sell them to access that wealth. They're all borrowable, they all appreciate, and they all have built-in tax advantages. That's the buy phase, building a portfolio of permanent, productive assets that you never intend to sell. Now let's talk about the magic. The borrow phase, how billionaires live tax-free. This is the part that makes tax lawyers and financial engineers absolutely giddy. Here's the key insight: loans are not income. Read that again. A loan is not income. It is not taxable. The IRS doesn't care if you borrow $100 million against your stock portfolio, because that's not income, it's debt. You have to pay it back. So, here's what the wealthy do. Instead of selling their assets and paying capital gains tax to access cash, they simply borrow against those assets. The assets stay in their portfolio, keep compounding, and they get cash in hand, completely tax-free. This is called a securities-backed line of credit, SBLOC, or a pledged asset line, PAL, in the world of stocks. In real estate, it's a home equity line of credit, HELOC, or a cash-out refinance. Let me give you a concrete example. The Elon Musk example. In 2021, reports revealed that Elon Musk paid $0 in federal income tax in 2018. Zero. And yet, he was the richest man in the world. How? Because his wealth was entirely in Tesla and SpaceX stock, paper wealth that isn't taxable until sold. When he needed cash, he borrowed against his shares. Banks were thrilled to lend to him because the collateral, Tesla stock, was worth far more than the loan. In 2021, it was reported that Musk had taken out over $6 billion in loans backed by his Tesla shares. At interest rates of 2 to 3%, which, by the way, were tax-deductible as investment interest expense, that's $120 to $180 million per year in interest. Compare that to what he'd have paid in capital gains taxes if he'd sold. The Larry Ellison example. Larry Ellison, co-founder of Oracle, is worth over $100 billion. He's been known to borrow hundreds of millions of dollars against his Oracle shares to fund his lavish lifestyle. The yachts, the Hawaiian island he purchased, literally, the tennis tournaments he sponsors. He doesn't sell Oracle stock. He borrows. The interest payments are manageable. The stock keeps growing. And his heirs will one day receive those shares at a stepped-up basis, potentially owing zero in capital gains tax. More on that in the die phase, how securities-backed loans work. Most major private banks, Morgan Stanley, Goldman Sachs, Bank of America, Private Bank, JP Morgan Private Bank, offer securities-backed lines of credit to high-net-worth clients. Here's how it typically works. 1. You have a stock portfolio worth $10 million. 2. The bank allows you to borrow up to 50 to 70% of the portfolio value, so $5 to $7 million. 3. The interest rate is typically the Secured Overnight Financing Rate, SOFR, plus a small spread, historically very low. 4. You draw on the line of credit as needed. You pay only interest, not principal. 5. As long as your portfolio stays above the required collateral level, the loan rolls on indefinitely. 6. If the market drops and your collateral value falls below a threshold, the bank issues a margin call, requiring you to add more collateral or repay part of the loan. This is the one risk, which we'll discuss. The beautiful thing is, there is no required repayment schedule on many of these loans. You pay interest, a relatively small amount compared to the portfolio's growth, and you let the loan sit. When you die, the loan gets repaid from the estate. More on why that's brilliant in part real estate, the HELOC and cash-out refinance. For real estate investors, the same principle applies. Say you bought a commercial building 20 years ago for $500,000. Today, it's worth $3 million. You've also paid down the mortgage, so you owe almost nothing on it. You have $2.5 million plus in equity sitting in that building. You could sell it and pay capital gains tax on $2.5 million in appreciation. Or you could do a cash-out refinance. You take out a new mortgage of $1.5 million against the property. You get $1.5 million in cash. You pay zero capital gains tax because you haven't sold anything. You now have a mortgage, but the interest on that mortgage may be tax deductible, and the property continues to appreciate. Old money does this over and over across dozens of properties. It's like having a private ATM that never runs dry, as long as your assets keep growing. The math that makes this work. Let's run the actual numbers to show why this is so powerful. Scenario A, you own $10 million in stock. You sell $1 million to fund your lifestyle. You pay 23.8% capital gains. Tax equals $238,000 to the IRS. You have $762,000 in cash. The $1 million in stock is gone, no longer compounding. Scenario B, you own $10 million in stock. You borrow $1 million against it at 4% interest. You pay $40,000 per year in interest, which may be tax deductible. You have $1 million in cash. The full $10 million in stock stays invested and keeps compounding. In scenario B, you're $238,000, richer from the tax savings alone in year one. Over 20 years, the $1 million you kept invested, instead of selling, could easily become $3 or $4 million. The difference is staggering. The cost of the loan is almost always less than the cost of the tax. That's the fundamental insight. Borrow cheap, keep the asset, let it compound. The risks of the borrow phase. Before we go further, let's be honest about the risks, because this strategy, done recklessly, has blown up some fortunes. Risk 1. Margin calls. If you borrow against stocks and those stocks crash 50%, you may face a margin call, forced to sell at exactly the wrong moment or inject more capital. This happened to some aggressive borrowers in 2008 and 2020. The solution? Never borrow more than 20 to 30% of your portfolio, giving yourself massive cushion. Risk 2. Rising interest rates. When the Federal Reserve raised rates aggressively in 2022 to 2023, variable rate loans suddenly became expensive. Wealthy borrowers who locked in cheap 2% rates found them jumping to 6 to 7%. Lesson: model scenarios with higher interest rates before borrowing. Risk 3. Asset concentration. Borrowing heavily against a single stock is extremely dangerous. If that company collapses, think Enron, Lehman Brothers, or more recently some tech darlings, your collateral evaporates and you're left with a massive loan and nothing to back it. Diversify before over-leveraging. The truly sophisticated wealthy use the borrow phase conservatively and strategically, not recklessly. Quick pause. If you're finding this valuable, smash that like button right now. It genuinely helps this channel reach more people who deserve to understand how wealth actually works. And drop a comment below. Have you ever heard of the buy, borrow, die strategy before today? I want to know. The die phase, the greatest tax loophole in history. Now we get to the part that most people find either brilliant or infuriating, depending on your perspective. This is where the strategy becomes truly generational. This is why old money stays old money. The die phase is built around one of the most powerful provisions in the U.S. tax code, the stepped-up basis at death. Let me explain this carefully because it's extraordinary. What is stepped-up basis? When you buy an asset, say, a share of Apple stock for $10, your cost basis is $10. That's what you paid. If you sell it later for $200, you owe capital gains tax on the $190 gain. Now here's what happens when you die owning that stock. Under current U.S. tax law, Section 1014 of the Internal Revenue Code, when an asset passes to an heir at death, the cost basis is stepped up to the fair market value on the date of death. So if you bought Apple stock for $10 and it's worth $200 when you die, your heir inherits it with a cost basis of $200, not $10, $200. That means if your heir immediately sells it at $200, they owe zero capital gains tax. The entire $190 of gain, representing decades of appreciation, is completely wiped out, tax-free, at the moment of your death. Let that sink in. The $190 gain per share, which you were carefully never selling specifically to avoid paying tax on, simply disappears from the tax code's perspective the moment you die. This is the die in buy, borrow, die. How this connects to the borrow phase. Now here's where the strategy comes full circle in an almost poetic way. Remember those loans you took out during the borrow phase? The $1 million, $10 million, $50 million you borrowed against your assets. When you die, those loans get repaid by the estate. The assets that collateralize those loans get stepped up in basis. Your heirs receive the remaining assets at the new stepped-up basis, potentially owing no capital gains tax. So, in effect, you borrowed money, lived your life, never paid capital gains tax, and when you died, the loans got settled and your heirs got clean, tax-free assets. You extracted cash from your wealth without ever triggering a taxable event for an entire lifetime. Across potentially billions of dollars of appreciation, this is not illegal. This is not a scandal. This is the law as it is written. And it has been this way for decades. Why does this law exist? Reasonable question. The stepped-up basis provision exists, in part because the alternative, taxing unrealized gains at death, would force heirs to sell family farms, family businesses, and other illiquid assets simply to pay the tax bill. Congress has generally been reluctant to create that kind of forced liquidation. There have been multiple attempts to reform or eliminate stepped-up basis. The Biden administration proposed eliminating it in 2021, but it has survived every legislative challenge so far, largely due to heavy lobbying from wealthy families and agricultural interests. The estate tax and how old money avoids it too. Now, stepped-up basis isn't the only death-related tax concern. There's also the federal estate tax, which is a tax on the total value of your estate when you die. As of 2024, the federal estate tax exemption is $13.61 million per individual, or $27.22 million for married couples. Estates below this threshold owe nothing. Estates above it owe up to 40% on the excess, 40% on the amount above the threshold. That could destroy a family's fortune across generations. Except old money families have developed highly sophisticated tools to avoid this too. Let's walk through the major ones. Tool 1. Irrevocable Life Insurance Trusts, ILITs. You take out a large life insurance policy, say $50 million, and place it inside an irrevocable trust. The trust owns the policy, not you. When you die, the $50 million death benefit goes to the trust outside your taxable estate. Your heirs receive those funds free of estate tax. The insurance premiums you paid, often funded through annual gift tax exclusions, currently $18,000 per person per year. A wealthy couple can gift up to $36,000 per person per year to heirs tax-free, and those heirs can use those gifts to pay the insurance premiums. Tool 2. Grantor Retained Annuity Trusts, GRATs. A GRAT is a trust where you transfer assets in, receive annuity payments for a fixed term, and at the end of the term, whatever appreciation remains in the trust passes to your heirs with little to no gift tax. Here's the genius. If the assets in the GRAT grow faster than the IRS's assumed interest rate, called the Section 7520 rate, all of that excess growth passes to heirs completely tax-free. Facebook's early investors used GRATs to transfer hundreds of millions in Facebook stock to their heirs before the IPO drove the price skyward. Tool 3. Dynasty Trusts. Some states, South Dakota, Nevada, Delaware, allow dynasty trusts that can last for hundreds of years, or even perpetually in some cases. Wealth placed in a dynasty trust can grow and be distributed to multiple generations of heirs, all while remaining outside any individual's taxable estate. This is exactly what old money families use to ensure wealth truly lasts forever. The Rockefeller family trusts have been operating for over a century. Tool 4. Family Limited Partnerships, FLPs. Wealthy families transfer assets into a family limited partnership, then gift or sell interests in the partnership to their heirs. Because minority interests in a private partnership have limited control and limited marketability, they qualify for valuation discounts, sometimes 20 to 40% below the underlying asset value. This means you can transfer more wealth while using less of your estate tax exemption. Tool 5. Charitable Remainder Trusts, CRTs. You transfer appreciated assets into a charitable trust. The trust sells the assets without paying capital gains tax, because charities are tax exempt. The proceeds are reinvested and pay you an income stream for life. When you die, the remaining assets go to your chosen charity. You get an immediate charitable deduction, elimination of capital gains tax, income for life, and estate tax reduction. Your heirs don't get that money, but the income stream to you can be structured to fund life insurance for your heirs. The point of all these tools: by the time old money families are done planning, their estates often pass to the next generation with a tiny fraction of what the statutory 40% estate tax rate would suggest. The family office, the command center of generational wealth. You cannot understand how old money operates without understanding the family office. A family office is essentially a private financial institution, a team of professionals hired exclusively to manage one family's wealth. Not a money manager who handles 200 clients, not a financial advisor juggling a book of business. A dedicated team whose only job is to grow and protect your family's wealth. The threshold to establish a single family office is typically $100 million or more in investable assets. At that level, the cost of a dedicated team of tax lawyers, estate planners, investment managers, accountants, and risk officers is justified by the savings they generate. What does a family office do? Tax planning across multiple entities, jurisdictions, and generations. Investment management, allocating capital across public markets, private equity, venture capital, real estate, and alternatives. Estate planning, constantly reviewing and updating trust structures, wills, and succession plans. Philanthropy, managing charitable foundations and donor-advised funds. Risk management, insurance, cybersecurity, personal security for family members. Education, preparing the next generation to be stewards of the wealth. The Rockefeller Family Office, Rockefeller Capital Management, has been operating in various forms for over a century. The Pritzker family, Hyatt Hotels, has a sophisticated family office. The Mars Candy family, the Cargill Macmillan family, the Bechtel family. For these families, the family office is the operating system upon which the buy, borrow, die strategy runs. It provides the institutional memory, the professional expertise, and the continuity that ensures the strategy works across generations, not just within one lifetime. For most people watching this, a full family office isn't realistic, but here's what is realistic. Building your own version of this team, a good CPA who understands tax strategy, an estate attorney who specializes in trusts, a fee-only financial advisor. That's your version of a family office, scaled to where you are today. How you can apply this right now. Now, I know what you're thinking. This is fascinating, but I'm not a billionaire. How does any of this apply to me? More than you might think. Here's how ordinary people can apply the principles of buy, borrow, die at every level of wealth. Level 1. Building the foundation, net worth, $0 to $250,000. At this stage, your focus is entirely on the buy phase. You are building the asset base that everything else depends on. What to do? Maximize contributions to tax-advantaged accounts. 401k, IRA, Roth IRA. These accounts grow without annual tax drag, the first form of tax deferral available to everyone. Start investing in broad market index funds. The S&P 500 has returned roughly 10% per year, historically over long periods. Buy it, hold it, never sell it. If you're a homeowner, treat your home as the beginning of your real estate portfolio. Build equity. Resist the urge to extract it frivolously. Understand that not selling is a strategy. Every time you're tempted to sell your investments because the market dropped, remember the wealthy are sitting on their assets and borrowing during those moments, not selling. Level 2. Beginning to borrow. Strategically, net worth $250,000 to $1 million. At this level, you can start accessing some of the borrow tools. What to do? If you own a home with significant equity, a HELOC is available to you. Use it strategically, not for consumer spending, but for income-producing investments. Using HELOC funds to buy a rental property, for example, is the residential version of what the wealthy do at scale. Many brokerage accounts offer margin accounts, the ability to borrow against your stock portfolio. Use this with extreme caution and only at conservative levels, 10 to 20% of portfolio value. The risk of margin calls is real. Begin working with a CPA who thinks about tax planning, not just tax filing. The difference is enormous. A tax filer does your taxes after the year ends. A tax planner structures your financial life during the year to minimize your burden. Open a Roth IRA if you haven't. The Roth is a mini version of the buy, borrow, die concept. Assets grow tax-free, and distributions in retirement are tax-free. Level 3, Advanced Implementation, Net Worth, $1 million to $10 million. Now you're playing a version of the real game. What to do? Consider a DAF, Donor Advised Fund. If you have appreciated stock you want to unload, don't sell it and donate the cash. Donate the stock directly to a DAF. You get a deduction at full market value. The DAF sells the stock and pays zero capital gains tax. You direct the DAF to give to your favorite charities over time. This is one of the most underused tax strategies available to millionaires. Explore cost segregation studies if you own investment real estate. A cost segregation study allows you to accelerate depreciation deductions, creating large paper losses that offset your other income. Work with an estate attorney to establish a revocable living trust at minimum, which avoids probate and ensures your assets transfer smoothly. At higher net worth levels, explore irrevocable trust structures. Begin thinking about life insurance not as a death benefit, but as a tax-free wealth transfer vehicle. Permanent life insurance, whole life or universal life, builds cash value that can be borrowed against tax-free. This is how many wealthy business owners create a private banking system. Level 4, the full strategy, $10 million plus. At this level, you're essentially running the full buy, borrow, die playbook. Securities-backed lines of credit from private banks, GRATs and other sophisticated trust structures, family-limited partnerships for estate discount planning, philanthropic structures, private foundations or CRTs, potentially establishing a multi-family office relationship. Part 7. The broader context. Is this fair? 42 minutes to 46 minutes. Let's take a step back and address something important, because this video wouldn't be complete without it. Is the buy, borrow, die strategy fair? This is a legitimate policy debate. On one side, economists and tax reform advocates argue that the stepped-up basis provision is a massive subsidy for dynastic wealth. The Congressional Budget Office has estimated that stepped-up basis costs the U.S. Treasury roughly $40 to $50 billion per year in foregone revenue. Over a decade, that's $400 to $500 billion that could fund schools, infrastructure, healthcare, or reduce taxes on working Americans. ProPublica's 2021 Secret IRS Files investigation revealed that the 25 wealthiest Americans paid an average effective tax rate of just 3.4% between 2014 and 2018, when their total wealth was measured against what they paid in taxes. This is the real-world result of buy, borrow, die applied at the billionaire level. On the other side, defenders of the current system argue that wealth was already taxed once when it was earned. They argue that forcing heirs to pay capital gains tax at death would require liquidating family businesses, farms, and other illiquid assets. They argue that capital flows more productively when not penalized. My view, and I'll give it to you straight, understanding how the system works is not the same as endorsing it. Whether or not you believe this system is equitable, you live inside it. The rules are the rules. And as long as these strategies are legal, the question isn't whether to use them. The question is whether you know about them. The families who know about these strategies use them. The families who don't know lose more to taxes, courts, and inflation with every passing generation. Knowledge is the great equalizer. That's why this channel exists. The mindset of old money, what they know that you don't. Beyond the mechanics of buy, borrow, die, there's a mindset that old money families cultivate, and it's arguably more important than any individual strategy. Mindset 1. Time horizon. Old money thinks in generations, not quarters. They are making decisions today that are designed to pay off in 50 years. Most people can barely think 5 years ahead. Extending your time horizon is the single most transformative thing you can do for your financial life. Mindset 2. Assets over income. The middle class optimizes for income, a good salary, a raise, a bonus. Old money optimizes for assets, things that produce income without requiring their time. The shift from thinking, how do I earn more, to what assets can I build or acquire, is the shift from the middle class to the wealth-building class. Mindset 3. The tax code is the instruction manual. Wealthy families don't resent the tax code. They study it. They hire people to find every legal advantage in it. They structure their lives around it. The tax code is literally the government's instruction manual for what behaviors it rewards. Old money reads that manual very carefully. Mindset 4. Debt is a tool, not a shame. The middle class is taught that debt is dangerous. Old money is taught that stupid debt is dangerous, but strategic debt is powerful. Borrowing at 4% to hold an asset growing at 12% is math that works in your favor. The key is purpose. Debt for liabilities, cars, vacations, consumer goods, destroys wealth. Debt for assets, real estate, securities, businesses, can build it. Mindset 5. Advisors are investments, not expenses. Old money families pay top dollar for top-tier lawyers, accountants, and financial advisors, because the cost of those advisors is a fraction of what those advisors save in taxes, protect in legal disputes, and earn in investment returns. The best investment some people can make is hiring the right expert. Let's bring this home. The buy, borrow, die strategy is not a trick or a cheat code. It is the disciplined, multi-generational application of 3 simple principles. Buy productive assets that appreciate and generate income. Never stop buying them. Treat them as permanent. Borrow against those assets to fund your lifestyle and additional investments, rather than selling and triggering taxes. Let the assets keep compounding while you access cheap capital. Die with those assets still in your portfolio, passing them to your heirs with a stepped-up cost basis, eliminating potentially decades of unrealized capital gains tax in a single moment. Wrap all of this in smart estate planning, tax advantage structures, and the right professional team. And you have a system that can keep a family wealthy for not just 1 generation, but 10. The Rockefellers, the Waltons, the Pritzkers, the Grosvenors, none of them invented this. They simply learned it, applied it consistently, and taught it to their children. Now you know it too. The question is, what will you do with it? If you want to go deeper on any of the strategies covered in this video, HELOCs, GRATs, family limited partnerships, securities-backed loans, let me know in the comments below which one you want me to break down in its own dedicated video. Subscribe if you haven't already. Share this video with someone who needs to hear it. This is the kind of financial education that genuinely changes lives, and I'll see you in the next one. And I'll